There is a deafening sound that fills the room when the trading monitors finally go dark for the weekend. It is not the sound of sirens, and it is not the sound of shouting. It is the sound of silence, a heavy, suffocating silence that presses down on the chest of every investor who watched their portfolio bleed out over the last 48 hours. We are sitting in the aftermath of a financial hurricane. The winds have died down, the rain has stopped, but the landscape has changed. You are looking at the wreckage of what you thought was a sure thing. You are looking at the red numbers on your screen that represent hours of your labor, years of your savings, and the dreams you attach to them. And in this silence, in this void between the closing bell of Friday and the opening bell of Sunday night, a dangerous voice begins to whisper in your ear. It is the voice of doubt. It is the voice that asks, "Was I wrong? Is this a scam? Did I just lose everything?" We need to confront that voice today. We need to drag it out into the light and dissect it with the cold, hard scalpel of logic. Because what you are feeling right now, the fear, the nausea, the regret, is not a reflection of reality. It is a reflection of psychology. It is the biological response to a financial event that was designed, engineered, and executed to break your spirit. The crash we just witnessed was not an accident. It was a harvest. It was a mechanism of the market doing exactly what it is designed to do: transfer wealth from the impatient to the patient, from the emotional to the disciplined, and from the leveraged to the liquid. To navigate the week ahead, and indeed the years ahead, we must first make a fundamental distinction that most investors spend their entire lives missing. We must distinguish between price and value. These two words are often used interchangeably, but in the world of precious metals, they are enemies. Price is noise. Price is a number flickering on a screen, generated by a computer algorithm in Chicago or London, influenced by high-frequency traders, derivatives, margin calls, and geopolitical rumors. Price is volatile. It screams. It demands your attention. It creates euphoria when it goes up and terror when it goes down. Value, on the other hand, is silent. Value is the bedrock reality of what an asset actually is. Value is the atomic structure of silver. It is the fact that it conducts electricity better than any other element in the universe. It is the fact that it has been used as money for 5,000 years across every civilization on Earth. It is the fact that it cannot be printed by a central bank. It is the fact that it is currently in a structural supply deficit that no amount of paper trading can fix. On Friday, the price of silver crashed. But did the value change? Did the silver in your safe suddenly rust? Did it lose its conductivity? Did the U.S. government pay off its $36 trillion debt, rendering the need for hard money obsolete? No. The value remained constant. Only the price changed. And when price falls below value, that is not a crisis. That is an opportunity. But you can only see it as an opportunity if you can silence the screaming of the price long enough to hear the whisper of the value. We need to perform an autopsy on the crash itself. We need to understand the mechanics of the slaughter so that you do not take it personally. This was not the market rejecting the thesis of silver. This was the market rejecting the leverage of the tourists. Over the last few weeks, as silver rallied, it attracted a swarm of speculators. These were not stackers. These were gamblers. They came looking for a quick profit. They bought silver futures contracts on margin. They bought call options with money they borrowed. They were renting the price action, not owning the asset. The financial system is a predator. It senses leverage the way a shark senses blood in the water. When the open interest, the number of outstanding bets, got too high, the exchanges changed the rules. They raised the margin requirements. This is a standard procedure in volatile markets. They said, if you want to keep playing this game, you need to put more cash on the table. The gamblers didn't have the cash. They were all in. So the brokerages stepped in and liquidated their positions, forced selling. This is critical to understand. The selling we saw was not voluntary. It was not a group of rational investors looking at the fundamentals and deciding to exit. It was a machine blindly executing sell orders to cover debts. When a margin call happens, the algorithm doesn't care about the long-term potential of silver. It doesn't care about the solar industry, it only cares about solvency. It sells at any price. This creates a feedback loop. The forced selling drives the price down, which triggers more margin calls, which drives the price down further. It becomes a cascade, a waterfall of liquidation. If you were holding physical silver, or if you were holding unleveraged positions, you were merely a spectator to this carnage. You were watching the casino clear out the drunk gamblers. It looked scary, but it didn't actually affect you unless you panicked and joined them in the selling. The system is designed to flush out the weak hands, the people who are overextended. Once those hands are flushed, the market is lighter. It is healthier. The overhang of leverage is gone, and the price can begin to find its true level based on organic demand rather than speculative froth. This brings us to the concept of the three silvers. To survive the coming week, and to survive the rest of this bull market, you must understand that silver is not just one thing. It is three distinct things masquerading as one word. And each of these three things behaves differently, reacts to different stimuli, and serves a different purpose in your portfolio. The first silver is paper silver. This is the silver of the futures market, the ETFs, the options chain. This is the silver that crashed on Friday. Paper silver is a financial derivative. It is a promise to pay. It is a betting slip. It is controlled by the banks and the hedge funds. It is infinitely printable. They can create 1 billion ounces of paper silver in a microsecond with a keystroke. This market is volatile, manipulated, and dangerous. If you play in this arena, you are stepping into a cage with tigers. You might get out alive, you might even make money, but do not be surprised if you get mauled. The crash was a paper silver event. The second silver is monetary silver. This is the silver in your safe, the coins, the bars, the rounds. This is the silver of history. This silver is insurance. It is wealth that exists outside the digital banking system. It has no counterparty risk. If the power grid goes down, if the bank fails, if the dollar collapses, this silver still exists. It still has purchasing power. This silver did not crash on Friday. In fact, if you tried to buy it on Saturday, you likely found that the premiums had gone up. The dealers know the difference between paper and metal. This silver is your sovereignty. It is your vote against the current monetary regime. It is the anchor that keeps your boat steady when the waves of inflation are crashing against the hull. The third silver is industrial silver. This is the silver of the future. This is the silver inside the solar panel on your roof, the silver in your iPhone, the silver in the missile guidance system, the silver in the electric vehicle. This silver is a strategic commodity. It is being consumed. It is disappearing. Once it is used in a missile, it is gone forever. The demand for this silver is growing exponentially as the world electrifies. The laws of physics dictate that we need this metal. There is no substitute that is as efficient. This silver is indifferent to the price on the COMEX. The factory needs it, regardless of what the chart says. When you feel the panic rising, ask yourself, which silver am I worried about? Are you worried about the paper betting slip, or are you worried about the strategic metal and the historical money? If you are a stacker, you own the second and third types of silver. The crash in the first type is irrelevant to you, except as a buying opportunity. The mistake most people make is that they own monetary silver, but they watch the price of paper silver. They let the casino dictate how they feel about their savings. You must break this psychological link. You must decouple your emotions from the spot price. Now let's talk about strategy. How do we handle this psychologically? How do we structure our wealth so that we don't get shaken out? We need to adopt the bucket strategy. This is a way of compartmentalizing your portfolio to match your psychology. You need a core bucket. This is your long-term hold. This is your insurance. This is the silver you bought for your grandchildren. This bucket has no sell button. It is locked away. You do not calculate its value in dollars every day because you do not intend to convert it back into dollars anytime soon. You measure this bucket in ounces. If the price drops 50%, you still have the same number of ounces. You sleep soundly because this bucket is not an investment. It is a legacy. Then you have a tactical bucket. This is the silver you bought to make a profit. This is the silver you trade. Maybe it's mining stocks, maybe it's an ETF, maybe it's a stack of generic rounds you plan to sell when the price hits $50. This bucket is allowed to be sold. It is allowed to be mobile. If you need cash, if you see a better opportunity in real estate or stocks, you liquidate from this bucket. The problem arises when people mix these buckets. They buy silver as a long-term insurance policy, but then they check the price like a day trader. They apply short-term anxiety to a long-term asset, or they buy silver to make a quick buck, but when the price drops, they claim they are in it for the long haul to avoid taking a loss, becoming bag holders by accident. You must be clear with yourself about the purpose of every ounce you own. Clarity kills panic. We also need to address the dangerous cult of never sell. In the precious metals community, there's a pervasive idea that selling is a sin, that having diamond hands means holding until the heat death of the universe. This is a trap. It is a form of financial martyrdom. You are not a trader if you sell some silver to pay for a life-saving surgery. You are not weak if you sell some silver to put a down payment on a farm. You are not foolish if you sell some silver to buy gold when the ratio favors it. Silver is a tool. It is a vehicle for transporting purchasing power through time. It serves you. You do not serve it. If you have a legitimate need for liquidity, or if you see a life-changing opportunity, do not let the dogma of the community paralyze you. The goal is not to die with the most metal in the ground. The goal is to live a free and prosperous life. The crash on Friday reminded us that liquidity matters. Having cash on the sidelines allows you to survive the downturns without being forced to sell your core position. Let's pivot to the industrial paradox. There is a narrative that industrial demand is infinite and price insensitive. This is mostly true, but it requires nuance. When the price of silver skyrockets, it triggers thrifting. Engineers and scientists start working overtime to find ways to use less silver in each solar panel. They try to substitute copper or aluminum where possible. They try to make the silver paste thinner. This is the market responding to price. High prices destroy marginal demand. However, and this is the crucial point, we are in a race between thrifting and volume. Yes, they are using less silver per panel, but they are installing 10 times as many panels. The explosion in volume is outpacing the gains in efficiency. We are building a new energy grid. We are building an AI infrastructure. We are rearming the world's militaries. All of these trends are metal intensive. The thrifting cannot keep up with the sheer scale of the build-out. Furthermore, there is a floor to thrifting. You can only reduce the silver content so much before the physics breaks down, before the solar panel loses efficiency, before the circuit board overheats. We are approaching those physical limits. This means that the demand for silver is becoming more and more inelastic. The industry simply must have it. And when you have inelastic demand meeting a constrained supply, the price adjustment when it comes is violent. It is not a gentle slope. It is a step function. So what are we looking for in the coming week? What are the signals that will tell us if the bottom is in or if there is more pain to come? First, watch the physical premiums. This is the most honest signal in the market. The spot price is the paper price. The premium is the cost of reality. If the spot price continues to drop on Monday and Tuesday, but the dealers raise their premiums, pay attention. That is the market screaming that the paper price is wrong. That is a divergence. It means the wholesalers are tight. It means the mints are struggling. It means the smart money is buying the dip aggressively. If you see spot down and premiums up, that is a green light to accumulate. Second, watch the futures curve. Specifically, look for backwardation. This is a condition where the current spot price is higher than the future price. It is rare in healthy markets. It signals a desperate shortage of immediate supply. If the front month contracts are trading at a premium to the back month contracts, it means the market is saying, I don't care about next year, I need the metal now. Backwardation is the hallmark of a physical squeeze. Third, watch the media narrative. This is a contrarian indicator. If you turn on the financial news and they are celebrating the crash of silver, if they are writing obituaries for the gold bulls, if they are mocking the stackers, smile. That is the bottom. The media is almost always wrong at the extremes. They extrapolate the current moment into forever. When the sentiment is universally bearish, when everyone has thrown in the towel, that is when the selling pressure is exhausted. There is no one left to sell. And when there are no sellers left, the only direction is up. Fourth, do not look for a V-bottom. Do not expect the price to shoot straight back up to the highs immediately. That can happen, but it is rare. Instead, look for stabilization. Look for the price to stop making lower lows. Look for it to grind sideways. Look for it to become boring. Boring is good. Boring means the leverage has been washed out and the market is building a new foundation. We want to see a base form, a platform from which the next launch can happen. We also need to discuss the dollar head fake. The crash in metals was largely driven by a spike in the dollar index, DXY. The narrative is that the U.S. economy is strong, rates will stay high, and the dollar is king. This is a mirage. The U.S. government is trapped in a debt spiral. They cannot afford high rates for long. The interest expense is eating the budget alive. Eventually, something will break. It might be the bond market. It might be the banking system. It might be commercial real estate. When it breaks, the Fed will pivot. They will cut rates. They will print money. They will sacrifice the dollar to save the system. This pivot is inevitable. It is not a matter of if, but when. And the market is forward-looking. The moment the market smells the pivot, the dollar will roll over and metals will explode. The crash we just saw was the market pricing in higher for longer. But higher for longer is a mathematical impossibility. It leads to default. So the dollar rally is temporary, the debasement is permanent. Bet on the permanent trend, not the temporary fluctuation. I want to speak directly to your mindset right now. The difference between a wealthy investor and a broke investor is not IQ. It is not access to inside information. It is temperament. It is the ability to keep your head when everyone around you is losing theirs. The market is an emotional amplifier. It takes your greed and your fear and turns the volume up to 11. If you cannot control your emotions, the market will control you. The crash was a test. It was a test of your conviction. Why did you buy silver in the first place? Did you buy it because you saw a YouTube video with a rocket ship thumbnail? Or did you buy it because you understand that the fiat currency experiment is failing? If your thesis was based on a thumbnail, you sold on Friday. If your thesis was based on history and math, you bought on Friday. The aftermath of a crash is always clarity. The fog of euphoria is gone. The tourists are gone. What is left is the reality. And the reality is that we are still in the early innings of a massive repricing of real assets. The ratio of paper assets, stocks, bonds to hard assets, commodities, land, gold, is at historical highs. This pendulum always swings back. We are watching the messy, volatile, violent beginning of that swing. Do not let the volatility scare you out of the trade of a lifetime. Volatility is the price of admission. It is the toll you pay to ride the rocket. If you want a smooth ride, put your money in a savings account and watch it slowly lose 5% of its purchasing power every year. That is a smooth, guaranteed loss. If you want to preserve your wealth and potentially grow it significantly, you have to accept the jagged line. You have to accept the gut punches. The week ahead will likely be volatile. We may see lower lows. We may see a fake out rally. We may see confused price action as the market tries to find its footing. Do not try to day trade this. Do not try to guess the bottom tick. Zoom out. Look at the monthly chart. Look at the yearly chart. The trend is up. The structure is bullish. The fundamentals are screaming. Write down your plan. Literally, get a piece of paper and write it down. If silver drops to $25, I will buy X ounces. If silver goes to $50, I will sell Y ounces. I will not sell my core bucket. When the panic hits, when the red candles are flashing, do not think, read the plan. Execute the plan. You are the general of your own financial army. A general does not run around the battlefield screaming. A general sits in the tent, looks at the map, and issues orders based on strategy, not fear. The silver crash of January 2026 is already becoming history. It will be a blip on the long-term chart. 10 years from now, you will look back at this chart and you will barely be able to see the dip, but you will remember how you felt. You will remember if you folded or if you held. You will remember if you let the bank steal your wealth or if you stood your ground. This is a war. It is a war between the fake economy of paper and debt and the real economy of resources and labor. The paper economy is fighting for its life. It is lashing out. It is using volatility as a weapon. But it is losing. It is losing because it violates the laws of nature. You cannot print wealth. You cannot borrow prosperity. Silver is truth. It is the honest ledger, and truth always wins in the end. It might take time. It might be painful, but the destination is set. So, take a deep breath. Turn off the hourly chart. Go spend time with your family. Go touch grass. Remind yourself that you are not your portfolio. You are a sovereign individual who has taken steps to protect yourself from a dying system. That is something to be proud of. That is something to be confident in. The storm has passed. The damage is done. Now we rebuild. Now we accumulate. Now we prepare for the next leg up. Because the fundamental drivers that brought us here, the debt, the inflation, the geopolitical chaos, they haven't gone anywhere. They are still here. And as long as they are here, silver has a job to do. Let it do its job, and you do yours. Be patient, be disciplined, be strong. The market has spoken. It said, get out if you are weak. If you are listening to this, you are still here. That means you are strong. Stay strong. The best is yet to come.